Section 1. The first step on your homeownership journey. A mortgage is nothing more than a loan you get to buy a home. It's a tool, and like any tool, you need to understand how to use it so it doesn't end up using you. For most folks, buying a house is the biggest purchase they will ever make, and a mortgage is what makes that dream possible. The house itself acts as collateral, which is just a fancy way of saying it's your promise to the bank that you will pay back every single penny you borrowed. If you break that promise and stop making payments, the lender has the right to take the house. That's a process called foreclosure, and it's a situation you want to avoid at all costs by being prepared. Understanding mortgages is not just for bankers or financial wizards. It's for you. It's for every hardworking person who dreams of having a place to call their own, a place to raise a family, and a place to build a future. Taking on a mortgage is a massive financial commitment, often lasting for decades, so you can't afford to walk into it blindly. Knowing the rules of the game before you start playing is the only way to win. This is your guide to doing just that. Section 2. Getting your ducks in a row. Pre-approval and down payments. The very first move you should make, before you even start looking at houses online, is to get pre-approved for a loan. This is not the same as a pre-qualification. Pre-approval is deeper. A lender digs into your finances, your income, your debt, your job history, your credit score to determine exactly how much they'll lend. Getting pre-approved shows sellers you're a serious, qualified buyer. That gives you a huge advantage when you make an offer. It also gives you a firm budget so you don't waste time on houses you can't afford. Once you know what you can borrow, focus on the down payment. The down payment is the part of the purchase price you pay up front in cash. The SMART goal is 20% of the home's value. On a $300,000 house, 20% is $60,000. Putting down 20% helps you avoid private mortgage insurance, PMI. PMI is an extra monthly fee that protects the lender, not you. So save aggressively to reach that 20% mark. Some loans will let you put down less than 20%, sometimes as little as 3 to 5%. That feels like a shortcut, but it's a dangerous trap. A smaller down payment means you borrow more, which means you pay significantly more in interest over the loan's life. You'll also have PMI every month until you reach 20% equity. Section 3. The nitty-gritty, loan types, interest, and terms. With your down payment saved, it's time to understand the engine of the mortgage, the loan itself. The two most common types of mortgages you will encounter are fixed-rate mortgage, adjustable-rate mortgage, or ARM. Let me be perfectly clear. The only type of mortgage you should ever get is a fixed-rate loan. With a fixed-rate mortgage, your interest rate is locked in for the entire life of the loan. Your principal and interest payment will never change, not in 5 years, not in 20 years. This gives you predictability and stability, which are essential for long-term financial planning and peace of mind. An adjustable-rate mortgage, on the other hand, is a disaster waiting to happen. An ARM might offer a lower teaser interest rate for the first few years, but after that initial period, the rate can change, often going up significantly. This means your monthly payment could suddenly jump by hundreds of dollars, potentially wrecking your budget and putting your home at risk. The bank is essentially shifting the risk of rising interest rates onto your shoulders. You should never sign up for a mortgage where your payment could change. Run from ARMs as fast as you can. They are a gimmick designed to get you into more house than you can afford. Next, you need to decide on the loan term, which is the length of time you have to pay back the loan. The most common terms are 30 years, 15 years. The 30-year mortgage is popular because it offers a lower monthly payment, making it seem more affordable. However, this is a costly illusion. The 15-year fixed-rate mortgage is the clear winner for anyone who wants to build wealth and get out of debt quickly. When you get a mortgage, your monthly payment isn't just for the loan itself. A typical mortgage payment, often referred to as PITI, principal, interest, taxes, insurance. The principal is the part of your payment that goes toward paying down the amount you borrowed. The interest is the fee you pay the bank for lending you the money. At the beginning of your loan, a huge portion of your payment goes toward interest. This process, called amortization, slowly shifts so that over time, more of your payment goes toward principal until the loan is paid off. The T and I in PD stand for property taxes, homeowners insurance, and you can't ignore them. Property taxes are what you pay to your local government to fund schools, roads, public services. Homeowners insurance protects your home from damage due to things like fire, storms, theft. Most lenders require you to pay these costs as part of your monthly mortgage payment. They will collect 1/12 each month and hold it in an escrow account. When the bills are due, the lender pays them for you from this account. On top of your monthly PT, you must be prepared for closing costs, typically 2 to 5% of your loan amount. On a $300,000 loan, that could be $6,000 to $15,000 in cash, on top of your down payment. Watch for any prepayment penalty. Ask directly, is there any penalty for paying this loan off early? The answer should be a firm no. The first and most powerful tip is to improve your credit score before you even talk to a lender. Your credit score drives the rate you're offered. Even a small drop in rate can save you thousands. The second tip is to shop around. Do not just go with the first lender you talk to or the bank where you have your checking account. A mortgage is a product. Compare offers from at least 3 to 5 different lenders, local banks, credit unions, reputable online mortgage companies. When you compare, don't just look at the interest rate. Ask for a detailed breakdown of all the fees and closing costs. A lender might offer a slightly lower rate but higher fees. Make them compete for your business. First, make a larger down payment if possible. Every extra dollar you put down is a dollar you don't have to borrow. Second, plan to make extra payments toward the principal. Pay a little extra each month, or make one extra payment per year. Even an extra $100 per month can shave years off your loan. Specify the extra funds go directly to the principal balance. Your next step is clear. If you're ready, find a trusted independent mortgage broker or loan officer who has the heart of a teacher. You want someone who will explain all your options and help you find the best deal, not push you into the loan that makes them the most commission. A good professional will guide you through pre-approval and paperwork. A mortgage is the largest debt you will ever take on. Approach it with wisdom, patience, and a solid plan, and you will turn that debt into a blessing and a cornerstone of your family's financial future.